Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, make your own financial conclusions, and make your own financial decisions. Today is Wednesday, December 7th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at the 1% challenge that we have laid out this week. You can go back, refresh your memory there. We added a couple plays. We want to talk about them. We want to update you on how the other plays are going. And before we hop to that, we want to give a shout out to our Discord, a link in the description below. You can hop in there, tell us how awesome our 1% trades are, how terrible they are, or just say hello. Talk to ourselves. Some of the other Blockhead traders love to hear from you. You can also find the link down there at thetagang.com/sprocket888, where each and every one of my trades are posted, the good, the bad, and the ugly. Lastly, this is also streamed via podcast, so wherever you get your podcasts, subscribe to ours. But let's hop to this week's content. Viper, the 1% challenge. The markets have taken a little bit of a sour turn since the euphoria last week, which just goes to all the volatility that's out there. But I believe you have been searching for some 1% play, and I stumbled across one as well after the market rally. And so I want to hop in and talk about a little bit of those today. And the trades, we started keeping a running tab of these, and so we'll kind of just pull it up right here. The first one is the inaugural trade that we actually talked about in last week's episode on Kohl's. This is where they stand today after the closing bell. Kohl's not looking so good on our first 1% inaugural play. We're down 121% on our P&L, which is roughly $37.50. I threw on a play actually last Friday. It was a very short play. I actually closed it out yesterday, and that was on the S&P futures. We'll talk about that maybe a little bit later, but I was able to ring that one out for 125% gain, or $125. And Viper, I think you put a trade on actually today, which is why the P&L is so itty bitty small right now, because it was just a few hours, I believe, before the market closed out on UMPQ.
Yeah. I mean, hey, it's positive, so that's a step in the right direction.
Yeah, we got two ahead and one behind. Hey, we'll take that. That's a 60+% win percentage.
There we go. Yeah. So, like I mentioned in the last episode, I'm using this 1% challenge as my re-entry back into all things equities, and that is in addition to, obviously, I've long since talked about DCAing into the index ETF funds. That's still happening. I'm gonna kind of mentally segment that over into its own forgotten about bucket. That's my drip faucet over there. And big picture, my plan is, with that position, those ETFs, I don't know. We'll see how it goes long term, but I'm not a huge just hold ETFs kind of guy, but I mean, maybe it'll be nice diversification. But my general plan, at least as it stands now, is as the markets recover, however long that takes, a year, 2 years, whatever, eventually as we recover, we'll hit a point where we just hit steady growth, rather than volatility DCA in and stuff. So at some point, I'll probably transfer those investments when they're well in the clear, over into trading and whatnot, more hands-on when things become a little less volatile. But for now, I like that as a little hedge to just DCA into the markets at large. And then over here, my re-entry is into equities again. And like I said, for anyone who missed it, the 1% challenge was something like $10 a week drip into your account just to start to get it funded. I've gone ahead and I've accelerated that for illustrative purposes. So I'm doing like $70 a week, I think, to drip in. And then I'm trying to plan to have a weekly play on that deposit. And so what that is meant to kind of simulate is, we've obviously talked about just letting it drip and letting it fill up as cash. But I kind of want to simulate, okay, so $70, if you're doing $10 a week, this is, 7 weeks in. Maybe you want to see what you can do. This obviously grossly violates the position sizing rule, especially initially, because, you're potentially investing 50, 60, 70, 100% of your account portfolio. So keep that in mind. And again, I'm offsetting that just knowing my time horizon as far as what is this $70 to my ultimate goal of dripping in. But I'll let you figure out, how you feel about that. It's mostly just to say not critical. I'm just doing these to show how I'm starting to feel out some.
I would add on your fear of position sizing. You are, and we'll cover this when you go in your play, you are putting stop losses in. And so that does kind of reduce your risk a little bit. I mean, you can still gap overnight and things like that, but you are somewhat controlling risk in that way.
Yeah, and that's a good point. And we'll look at exactly how much that stop is and possibly, like you said, completely resolve the concern with that. So let's dive in to where I started. So I was like, all right, I got to come up with a play, and it's been a while. It's been a while, but I've also gained. It's interesting. It's been 8 or 9 months since I left.
I was gonna say almost a year. You kind of bowed out right after the new year,
which is crazy. What happened this year? But I feel like I've never. Hopefully it's been portrayed on the show that I've never stopped learning. And obviously we've done a ton of content on price action, technical analysis. So it was very interesting to come back in with completely fresh eyes and go, how do I scope out a play? And obviously we've seen Sprocket's screener multiple times, and he's got it down to a very refined, going into the screener and Thinkorswim and filtering all this stuff. So I was like, all right, I need to do better about finding plays, both for consistency on performance evaluation, as well as just sanity and efficiency in time. I mean, the faster you get to a play, the quicker you put the play on, and then the quicker whatever happens. And then, we'll continue to pound the hammer. The more you do repetitively, the more you can adjust and tweak meaningfully. So I decided, why not start with my old friend FinViz? This is probably one of my favorite websites to screen for stocks. I mean, I'm barely touching the surface. But I'm going to drive into where I like to go, which is the screener tab over here. And what I want to make clear as I go through some of these things that I screen for, this is just my, I'll try to explain some of them, but I want to stress this isn't like copy and paste this recipe. Like this is a very personal flavor. This is me seasoning my eggs in the morning, or these are things that have become meaningful to me because of the journey so far through technical analysis, through price action and all that kind of stuff. I've taken what I've learned there and then gone, how do I turn that into a technical tool that I can surface something? So that is just to say, I don't want this to be some like, oh, well, he just used this, and this. I'm going to copy that. I've been there. I did it. I found some good plays, but it really doesn't mean anything to you, because you don't understand why it was chosen. But nonetheless, I go ahead and I start here by just drilling into the NASDAQ. The other thing I do on the descriptive tab here is I want average volume. I mean, we start big. Let's go over 1 million. This is a issue of liquidity. This is an issue of moving and getting those order fills. I mean, same stuff we talk about on options. For now, I leave the rest of this. Oh, no, I'm sorry. Price. We need to be careful here because I'm only playing with $70 this week. So I came over here and I believe I did something like under 30 because I mean, I could do all the way up to 50, under 50, but something about having 2 shares of something feels better. Current volume. So that's all I use here on the descriptive, and then we go over to technical. And there's a quick thing that I'm still feeling this out, but I do like how quickly it got me to a play, as we're about to see. The only thing I touch on the technical here is I say the 200-day simple moving average. I just want to know if we scroll down here, price crossed the SMA 200. That's all I want to know is, did the price cross it? So I want to explain that just really quickly here, my thought process in that, because like I said, everything's a work in progress. So if we go over here and if we pull up, let's just pull up Amazon, since we've talked about that quite a bit. The blue line here is the 200-day SMA or EMA in this case. And the reason I wanted to pull this into my screener is because if we look over time, the 200-day EMA is a fairly reliable trend data point. And I don't know, I really want to say that carefully, because none of this is isolated. None of this in a vacuum is something you should rely on completely. I mean, there's people that'll trade completely on the EMA and like, that's not what I'm trying to use it for. I just want to know what trend are we most likely in. And as you can see here, it's fairly reliable at predicting the trend you're in. You get this little test here, and we tried to break into a downtrend, but it failed. And then we confirm support again. And you see how every time we gap away from it, we kind of go sideways until we get back to it. And then on the downside, now that we have plenty of data on a bear market, same sort of thing in reverse, as far as we tried, we failed, we got far away from it, we went sideways, we came back to it, et cetera, et cetera, et cetera. So, so what I wanted to do in the screening was just say, all right, I don't want to get too picky on the EMA. I just want to know, did we cross it? Because if we crossed it, we're potentially doing something trend-wise, and I want to know what that is. So that's all I put into the technical here, was just, did the price cross the SMA 200? And now we have a list of things that meet this criteria. And so if we click on this button here, charts, we conveniently get to see charts for all of these. And so now I kick into that technical analysis price action mindset. And so I want to look for plays that are potential retraces to an important level. I want to look for important trend reversals and try to seize on those. And so I just kind of go through each of these, the charts that pop up here. There's a couple new ones that popped up, so I'm not going to go over all of them, but like, let's say FYBR here. Nope, I don't really like what I'm seeing here. We're swinging. I mean, we're at the top, but this is a channel. We're not coming off of retesting some critical level. This ESPR is in an uptrend, but price is right here in the middle. We're touching the EMA. But I'm looking at critical levels in my head, and just not seeing anything too advantageous on any of those. NWS down here is interesting. We have a flat bottom, and the chart here is calling out it's a multiple bottom, so it's flat there. We're getting higher highs. We are retracing on it though, but this is interesting. Maybe something I'll put some alerts on when we get to a price that matters to me. But that's just the gist of as I go through here. And when we keep going through, all of a sudden we get conveniently to the very last one, UMPQ. And this is exactly what I saw today. And as long as you have TA, as you can see right here, as long as you, if this pertains to you, I mean, if you know what you're looking at, I'd like to have this ticked on, because we kind of get these AI, algorithmically generated TA lines spotted. And rather than be overwhelmed, like, the first thing I see in UMPQ is this blue line, which the TA has automatically spotted. We have an uptrend on higher lows, and this this blue line that it called out. So I'm going to click on it because this all piqued my interest as soon as I saw it. We have this level that's coming across here. We have a gain and then a higher high, and we're retracing right back to that level. So we're doing a very solid retrace test of this level. So I'm in. This has everything that I would want to see in a potential play. So just skipping over to a little more interactive of a chart. Again, this is spotting that level that it called out. Roughly, I dialed it in a little bit to the 1825 here. We're the range, which might not be super visible in this box here. I can make this a little bit darker. The range this is the swing that made this new local high. So it started here, and we put this little range on, and so we're saying we're good. The price action is satisfied with an expectation of coming back and testing this area, and then obviously what has the higher probability is getting support and bouncing off of this. Obviously, that's not a guarantee. Here's the other thing. Let's keep in mind that 200-day moving average. Here's the other thing that I like on this play is we have this uptrend. We broke through and went into a downtrend, and now we've currently broken. We've tried and failed, and now we've gained the 200 EMA again, and we're coming back and we're actually giving the 200 EMA a test. And so this is just another thing I like to see for Confluence, that we're giving it a supportive test. We're not testing it as resistance. We're testing it as support, and we have Confluence on this more fundamental TA level here. So long story short, I said I like it. The price is right for, if I got $70 in my account. So you can see that when I spotted this, like Sprocket said, it was towards the end of the day. So if we go to like the 15-minute, it was somewhere in here as to when I actually entered. And this, I'm going to try to gloss over because I don't want to get too lost in the weeds here, but making the actual entry, trying not to catch the knife, but going into this lower time frame, now that the higher time frame criteria have all been met, you could come into the lower time frame here and kind of wait for a signal on a lower time frame when to enter. You can see on the lower time frame here, we made a low, and if I grab a marker and just roughly chop here, there was this level. We made a low here and then quickly regained and tested that level. So that's a very good early reversal sign. So for me, that was good enough. That was, as you can see, I try to put my entry like literally on the candle that it happened. So I did it right here on this green tick. So I could wait and see what happens next and see if we get a higher high off of this here. Just for a little bit more of that confirmation that we have confirmed a trend reversal and make my entry a little bit higher up here, or catch you got a lot of options is the takeaway. I was comfortable with what I saw here, and so that's why I went ahead and jumped in. And setting my profit target, we real quick zoom out a little bit. I wanted the profit target to be, let's go to like the 4 hour here for a little less data. So what I'm trying to do with these plays is something new for me, which is, just really, I'm playing the swing. There's a probable swing that's about to happen. I'm just playing that swing, and I'm getting out and I'm rolling the dice, and I'm going to go hit that screener, see who else pops on my screener. That's it. Previous me was like, oh yeah, this is a good setup. And then what if it goes to the moon? What if what if this is a big trend? That's too much. Like, I'm trying to be, very rigid and focused. And that's, part of that. So you have the knobs on the machine you can tweak. So my profit target is testing the level that we just swung down from. So the level that just took us down, I have marked here at 1981. And so this also increases your odds of success because, yeah, sure, big picture, this thing could be recovering into a little bit of an uptrend. I don't care. I'm not trying to play that. The highest probability of success is to say there is a high probability that we're coming down here and that we're at least going to go test this level. We start to get into lower and lower probabilities as far as what happens next after we test that level. We could get rejected. We could gain it and test and keep going. But now we're in the weeds, and I don't know anything about this company, this share, this whatever it is, holdings. If it's an ETF, whatever. So I'm trying to just play the swing. So I see this 1981 here. I like that as the test level when I want to duck out. If I did want to extend this play, I guess it's important to note the profit target 1 is when you would take your first profit target, your biggest one. You could leave some runners in there in case you think if this was a bull market, everything is up and to the right, then yeah, absolutely. Let's take a profit and let's leave a runner in there, set a trailing stop. So then we really don't have to worry about it. But that's not this play. And then for the stop loss, I'm using a 3-to-1 ratio, which is to say of the potential profit gained, what is 1/3 of that for the potential loss? Or said another way, what is my loss such that I'm risking 1 to gain 3? And so that math doesn't quite, I don't have the math exactly on the top of my head, but that math put the 1/3 ratio somewhere, I believe, around 1830, which was just a little too aggressive for me. Still, I mean, we had this wick down here, 1832, still totally doable. It's just a little too aggressive for what I was looking for. So I went ahead and just tweaked it a little bit to drop it to 1820 here, which is just below this level, which I definitely consider an invalidation to lose this range here. So that's the gist of the play, and how I got to it. And I mean, like any play should, 3 hours after you opened it, I'm feeling pretty good about it. But I don't know. I mean, I don't know if you have any thoughts, Sprocket, or if you want to give your thoughts and pull up. I think we have a little bit of a summary of all of the shabubabub that I just spewed at everybody, which might make it a little easier to comprehend.
I'll just run through the summary. I don't really have much thoughts on the play other than seems like a decent setup. What we got here is I like how we're kind of varying some of these plays. The initial one was selling options. The one we haven't talked about is buying options. This is just straight shares. So just to recap, you basically bought 3 shares of UMPQ. You paid $18.54 for those. You're looking at a stop loss where you set, hey, I'm going to sell these things, liquidate if this price hits 1820. That's a standing order that you have in right now. So, you can go about your day job and your day-to-day life knowing, hey, if that hits it, the order is going to fill and that'll take care of that. If that happens, which is your worst case scenario, you're going to be dropping out $1.05 on your play. And this really kind of speaks to that. You're not really risking, 70% of your portfolio here or 80% because you're going to be stopped out at 1820. You do risk a little bit of a gap down. Like, let's say this thing got terrible news overnight and opened tomorrow at $16. Okay, well, you're not going to get out at 1820. You're going to be out at $16. So just know that stop loss is not a guaranteed stop loss because you're at the mercy of what happens after hours and where things open and they're not continuously traded. But let's talk about the rosy side. The rosy side is you set your price target there at $19.81 of the share price. That would net you $3.81 gain. So you're basically looking at a potential of about a 7% upside. Worst case scenario, you're looking at about a 1.9% loss. Like you mentioned, your stop loss is really set at the invalidation of the price action, which is good because now you've picked a objective value that says, hey, look, this is my thesis, this is my theory on why this is going up. As soon as that's busted, I'm gonna step out. And that really fit into the risking 1 to make 3 risk to reward ratio that you were targeting, and that really is the UMPQ trade. We'll keep eyes on it to see how it goes. Yeah, Viper. So, one thing that I really snuck in, I actually wasn't planning on setting up another play because I think we're going to try to rotate a little bit of a who's picking trades. We can't get too many of these 1% trades going. Otherwise, we'll probably be taking forever to re-summarize and recap things like that. But the market euphoria last week, and I've really been trying to understand how to tie in price action to my volatility stuff. It was a trade on the S&P futures, and one of the things that I've been kind of doing is plotting different trend lines on many different tickers, things like that. And let's hop over here to my chart on the S&P. So this is the futures of the S&P, and I guess I technically kind of have the play up here, which I'll talk about in a minute. But the important part that I want to call out is this channel that I've been noticing is, and on this channel, you can kind of see we got a high, a high, a high, and we got this channel in here. And every time we come up, we bump against it, and then we fall down. And we hit the bottom of this channel, we bump against it. We actually broke through here a little bit, but we kind of quickly snapped back into that channel. We went back up, tried to break out, failed, went back down. And so I kind of noticed this thing, and I said, you know what might be a good thing to do is look for what trades are available the next time this thing charges up to the top of this range. At that point, which is where we found ourselves after the Jerome Powell comments last week. We had this monster day right here with a big candle that basically took us right up to that trend line. And I said, okay, what kind of plays do we have going here? And one of the things with my style is I love options, but selling options really requires elevated volatility. And I noticed that the volatility on the S&P index was just super low. So that is absolutely not what you want to sell, because when you sell volatility, you want that volatility to come down. That helps you keep more money in your pocket. That helps you reach your profit targets faster. When volatility is already really low, your odds are against you that volatility is going to go even lower. And basically, this was in the 12% historical volatility range. When you get into that really low volatility, this is saying that the premiums and options are cheap. They're low cost because volatility is low, and that means the probability of insurance needed is kind of down there, so the premiums are low. So that is a perfect time to actually buy options if you go out to buy them, because you're not paying this exuberant price because of elevated volatility. And so if I'm at the top of the range, I'm like, great, I want to buy some options. But my thesis is that this thing is going to go down in price from this. Like, it's going to reject off this level. So what I wanted to do was buy a put, which is basically like your insurance. It gives me the opportunity to sell shares at a lower price, or at a price where I make money if the stock goes down. Now, wanted to keep with the 1% rule, so I wanted to basically make a $100 limit to my trade. And the only way you can do that is basically by doing a vertical. This is like the exact opposite of what we did with Kohl's, where we sold a vertical. Here, we bought a vertical. And so I bought a 39.50 put, and I sold a 39.40 put. That is effectively a $1 difference. I know you do the math and you're like, but Sprocket, that's $10 difference. This is futures. I don't want to get into why they're marked a little bit different, but it's effectively $100 width there. And so the reason I pick those levels is because, if you look on here, you've got this period where we kind of rallied up and we almost went horizontal and consolidated here for a while. And this was really around a 39.50 level. 39.50 was the lower end of that. And so I thought, you know what? We could be starting a bull uptrend here. I'm not really sure. I feel we're going to retrace back. I shouldn't say I know. There was a high probability we were going to retrace back, because I got the option at low volatility, if that were to come down to a strike price of 39.50, that would be at the money. Volatility would be going up, up, up because price is coming back down. And we're at the money, which is going to be one of the thickest places for premium. So here, I want my premium to go up because I want to turn around and sell the premium back. And so this is where I kind of facilitated or came up with that play. Play was, let's buy a 39.50 put, which was a 20 delta put down because it was pretty far away from when I bought it. And I bought it pretty cheap because I basically bought that vertical for $100. And the thesis of the trade was, if this thing traces back to that at the money, step off the train because you're going to have profit green. Sure, you could go lower. If we blow through that, okay, maybe hang on to it. But if you're not sure, step off the train there and get out. Worst case scenario, we don't reject off that level and we just go past out this channel. We go up to the moon, wherever, and I lose my premium and I'm out that $100 of that option spread. And that's the risk when buying options, is you literally can lose 100%. So I'm going to pull up here in a second the actual mechanics of the play that I put on, but I charted out the thing here where this red box at the top here, this is my loss. So this is the option that I bought. If the price stays up here in this red box at expiration, it was a very short expiration, just 16 days to expiration, I would lose my premium that I paid because the coupon would be worthless. But should this thing come down into this green box or lower, pretend these boxes go to infinity above and infinity below, I potentially could make up to $400 based on the spread. Because I did the spread, you're capped at the one side, top and the bottom. So $400 was my max potential profit. $100 was my max potential loss. So let's look at this through a summary here. So again, I basically bought a put vertical, which means I bought the 39.50 put. I sold the 39.40 with December 16th expiration. I wanted to keep this real tight, real small. People always talk about a Santa Claus rally. People always talk about end of the year rally. I really wanted this trade to be, hey, I'm coming off that high. I'm going to trace back to something. I want to make a quick bang, bang. Buying a future, shorting a future, that's too expensive for the 1% play. So I needed to go with these option verticals to keep it that $100 trade. So I entered this on Friday, September 2nd. I paid $100 for that. In that trade, I had a potential of 400% upside because basically the $400 is what I could have picked up should we have expired in the money, basically below 39.40 upon expiration. Worst case, I lose that whole $100. So kind of risky there. Best part, I gained 400. So I actually exited yesterday for $125 profit. I closed out, sold the thing back for $225. And we put that here in the summary trade. So I got back the $100 I spent. I added 125, closed it out. That basically made 125% profit on that trade. So I was happy with it. I don't really have a lot of experience in working on those option trades that you buy. So I'm not really sure what the appropriate exit point is from a percentage basis. I have rules on the option selling. This was time bound. And so I decided not to hang out too long because no one ever really got in trouble for making a profit. That's a saying I always kind of mention to people. And my theory was if we trace back to that 39.50, that would have been enough of a volatility increase, price movement to at the money that I could close that option out and not be at risk for losing it. And I'd have green at that point. So that was a quick play I snuck in there, Viper. I mentioned it in the Discord, but it was kind of boom, boom, gone.
Which, that's a good play. That you can spin it, take it, move on. Stepping outside your, I don't want to say completely outside your comfort zone, but a fairly new mechanic for you.
So that brings us to the end of this week's episode. There's a couple of 1% plays that we've already thrown out there for you guys. Hopefully you're starting to see a little bit of a theme here with stuff. It maybe piques some curiosity in your mind, lets you help explore. You can kind of see the thought process we're going through, how we're tackling it, how we're putting it up there. We're really keeping these trades small. So small potatoes here as far as risk goes. And, we're dripping into our accounts. At that 1% challenge rate that we threw out there. So excited to see what additional trades we come up with. We'll slowly be building this record, for better or for worse, of our performance of these trades. And the internet shall judge us at some point in the future. Market's pretty volatile, a lot more data points coming out there. So good luck out there. Have fun. And remember, think outside the block.